Let's get live now to San Francisco and get thoughts on the markets. Katherine Schapiro, Senior Vice President and Portfolio Manager at Sentinel Asset Management, joins us, where she helps oversee about $20 billion in assets. Kate, good to have you on the program today. So first off, let's talk about the trading range. Are we just at the top of this trading range? Do people just need to pull back a little bit, or is this a bigger concern than we believe at this point?
We see it just as a pullback. It's after such a strong first quarter, it's not a surprise to expect some profit taking, given the Fed announcement, the Spain auction. We have a little room here for some downside, and frankly, we think that's healthy. But overall, looking throughout the entire year, we're more constructive on global equities in general and the U.S. In particular.
Okay, so how long do you think this pullback will last? I mean, how much of a pullback? Are we just looking at a mere maybe 5% one?
Well, I think in the short term, what we're coming up in the U.S. market, of course, to earnings season. And you're already seeing, obviously, with the Monsanto this morning, SanDisk, that there is some early comments coming out that could be interpreted as disappointing. We see that's certainly part of our expectations. Don't forget, a lot of these companies reported very strong earnings in 2011, so they're going to have some tough comparisons. That might continue to see some of this downslide. Then I think once we get out of this pre-announcement stage, you should see some rally back up towards the top of the range again.
Okay, so top of the range. How do you think markets will finish off this year, considering you're still net buyers of stocks?
Well, we think actually that it's a fairly supportive market for stocks going higher. In general, we've got an economic climate that is somewhat better than people had expected, and there is some disappointment or concern that the Fed is taking away the punch bowl, so to speak, but frankly, they're just on hold. We don't see them changing their accommodative policy at the moment. It's just they're not going to stimulate more unless, of course, they start to see worrying signs. Now, right now, the signs are not very worrying. In fact, they're quite good. Obviously, the employment numbers continue to be the focus, and right now they're very supportive.
Okay, so they're very supportive, but how much more can you make in the markets? That's what I'm asking you, Kate. Can you put a number to it?
Oh, without necessarily putting a target on it, I mean, I think, we had a double-digit return in the first quarter, up about 11, 12%. And, in a really good year, especially following a year like last year, it's not unlikely to see more of like a 20% return. I think that might be a stretch, but if you have earnings plus valuation expansion, right now we've got a PE on the market, on the U.S. market, of about 13. Maybe it goes to 15 if earnings stay solid, inflation stays under control, and the growth comes in as expected.
Right, and Europe, of course, stays where it is, which is relatively calm. But then overnight, we had Spain and this concern about the debt auction and Spain not being able to sell enough of its bonds. We had the yields surging. Yes, what happens to Europe?
Well, I think that obviously Europe is not completely out of the woods, and the Spanish bond auction is an indication of that. But you were talking earlier that Draghi was concerned about inflation and whether they should start pulling some of the LTRO back away from the markets. I think that what went on in Spain is an indication that the European Central Bank really needs to stay accommodative. I mean, these austerity measures continue to put downward pressure on the market. The central bank has to provide liquidity. And if it continues to do so, as we believe it will, we think that Europe as a whole avoids the really deep recession. And outside of some of the problem areas, such as Greece and perhaps Spain, Portugal, the rest of the core stays pretty healthy.
Okay, so you think Europe, it looks a little bit contained. Okay, what about China then? I got to ask you quickly about China and growth concerns here. How does that impact, I guess, your concerns about the markets going forward?
Well, I think that, the disappointment with China, perhaps, is that, they came off of a very strong year last year, stronger growth than perhaps most anticipated. So now they're going to slow down this year, 7 to 8% growth, Some people call that the hard landing. Some people call that the soft landing. In my book, I kind of see that more as the soft landing. And frankly, from a global growth perspective, China growing at 7.5% is still very, very good numbers. And they are shifting their consumption patterns, so that's where we think the investments should be made. And frankly, if we start to see slowing growth even below this 7% number, we think that the government has the levers to pull to start to stimulate if they need to.
Okay.
Right now, they don't need to.
Okay, Katherine, enjoy your Easter weekend. Thanks for your time. Kate Schapiro there, Senior Vice President and Portfolio Manager at Sentinel Asset Management.